Commodities, but let's take a look at oil and gas stocks as we turn our attention to the Nigeria energy market. So on Friday, this is how the top 7 of the oil and gas stocks we tracked finished off at the Nigerian Stock Exchange, which was the last trading day for the year 2016. So corn oil was largely unchanged percentage-wise, but there was a volume of 15,713 units on it as it closed at 37 naira 48 kobo. Forte Oil and Mobil were the two major losers on this particular index, dropping 9.74 and 3.79% respectively to close at 84 naira 43 kobo and 279 naira. MRS was also unchanged percentage-wise, but there was a volume of 4,895. Seplat and Total also unchanged at the end of trade on Friday. But Owando notched up 3.30% to close at 4 naira 70 kobo. So at the end of the 3 days of trade, just signified the end of the week for 2016, the index came in at 1.47%. Year to date is at minus 12.31, and price to earnings at 38.7, with dividend yield at 2.0. So, like Adam mentioned as we started our conversation, one of the biggest issues is the fact that the Organization of Petroleum Exporting Country deal kicks in today, 1.2 million barrels per day to be shaved off oil outputs. Let's talk to Dolapo Oni, who's the head of energy research at EcoBank, and get his thoughts on this. Dolapo, good morning to you.
Good morning, Harriet. Thanks for having me.
It's great to have you join me on the show. So let's talk about this deal. How is the market shaping up? It looks like already we have oil prices in a tizzy based on this particular deal that kicks on today.
Yes, I think it's the market is it's been a bit positive about the OPEC cut, because we're already seeing signs that both the OPEC countries and the non-OPEC countries are looking to comply with that particular move. A few, anyway. We've seen some action by Kuwait. Kuwait has shut down a couple of wells, about between 80 to 90 wells, trying to reduce their production. Similar action from some of the African countries as well, although, I mean, theirs is related to some technical issues as well. But then among the non-OPEC countries, a country like Oman has already informed its customers that we're going to be reducing our volumes from this month. So expect lower cargoes from next month, February and March. So we started to see some action, of course, but there are always the what I call the wet blankets. So you have Russia, who is supposed to cut 300,000 barrels per day, and I mean, there's no action yet, but who knows? It's early days, so maybe we'll see something from them.
So do you expect that this deal will kind of calm the markets?
Yeah, basically, because this is what the deal should achieve. December was pumping about close to 34 million barrels per day. If they cut 1.2 million barrels per day, that brings them to about 32.6, 32.8 million barrels per day. What they've forecasted is that the gap in the market should be around 1.2 million barrels per day. If they make this cut and non-OPEC countries make their own cut of about 600,000 barrels per day, then the market gap should close, and then we should have support for much higher prices. But again, that doesn't include the fact that we expect Libya and Nigeria and some other non-OPEC countries to continue ramping up production. So it should calm the market a bit, which should allow us to see prices slightly above $60 per barrel, maybe 61, 62. But I think unless there's a significant supply shock or demand shock or geopolitical tension, oil prices shouldn't exceed $63, $64.
All right, so in terms of looking at the cargoes available for Nigeria to export at the moment, are we good to enter the market starting in 2017, especially in light of how most of these other oil countries have positioned themselves to start the year?
Well, basically, it's still a good one for Nigeria because we still have a relative peace in the Niger Delta. We ended the year around 1.8 million barrels per day. I think that's still where we are, 1.8-ish. Agbami maintenance should conclude hopefully later this month, and once that concludes, that's another 125,000 barrels per day added back, which should take us to 1.9 million barrels per day. So we should be about okay where we are right now. As long as we can keep production at this level or slightly higher, it should be a fantastic year for us. But the key question will be if we can keep output at this level.
But Dolapo, talk to us a little bit more about the exports that we have, the cargoes that we have on ground ready for export.
No, well, I mean, we typically have about some 18, 19 different grades available for export. I think we still have Brass River offline. We still have some issues with Bonny Light. We don't have full load for Bonny Light yet, but we have pretty much every other. And then Focados, of course, is still offline as well too, up until February, early March. So pretty much every other cargo is available. Pennington, all the usual
But do we have off-takers? Because you see, everybody seems to want a specific kind of, of the crude. If it's not Bonny Light, it's Focados that we have more investors interested in. So it still seems as if we're literally sitting on our hands.
No, you see, not really. Let me say this. Let me put it this way. Pretty much every month, the market clears. So whatever cargo Nigeria sends to the market typically clears. Some cargoes take a lot longer in the market, but eventually the market clears. So let me say, typically the way the market looks right now, we still have a lot of Asian interest in the market. We still have Indians buying Nigerian cargoes. We still have even U.S. companies buying Nigerian cargoes as well. But of course, the preferred grades are not in the market. I mean, Focados is not in the market. That's a very strong preference for a lot of refiners. Bonny Light, we don't have full capacity load. Agbam is also not full capacity with some maintenance. So we still have a lot of the preferred cargoes not online. Brass River is also a favorite, even for other African refiners, Cameroon, Ghana, a lot of them buy Brass River. So that's not available as well too, but most of the other cargoes are available, and because they are all Nigerian crude anyway, they are light, they are sweet, it will still move in the market. But again, the key thing to note is that we should watch. Libya is coming on stream. Libya has ramped up to 685. Libya is a major threat for us in the European market because, number one, they are closer to Europe. They also sell a lot of light and sweet grades, and they have a significant amount of volume they can bring on stream. Currently, they are doing 685. If they can ramp up to 1 million barrels per day, it starts to put some challenge to our cargoes going to Europe. It slows them down with base. They don't move as fast as they should, affects our revenue cycle. So that's something to watch out for.
Well, thank you so much, Dolapo, for putting us on watch alert. Dolapo Oni is the head of energy research at EcoBank. Joins us there to give us his perspectives on developments in the energy market and how it, of course, affects Nigeria. But Business Morning continues in just a moment. We turn our attention to another sector of the economy in just a bit. Stay with us.